If I handed you $10,000 right now and said invest this for your future, would you pick QQQ, SPY, or VTI? Make your choice now because what I'm about to show you might completely change your mind. Here's the thing. This single decision could be the difference between retiring comfortably or working until you're 70. One of these ETFs turned $10,000 into over $67,000 in the last decade. Another kept you safer during crashes but cost you massive gains. And the third? It might be the perfect middle ground you never knew existed. Look, with AI reshaping everything, tech volatility at all-time highs, and everyone debating whether we're in a bubble, your ETF choice has never mattered more. I'm going to show you the real performance data, expose the hidden costs that are silently stealing your wealth, and run these 3 ETFs through brutal market scenarios. By the end, you'll know exactly which one fits your goals, or if you should be using all 3. Plus, I'll reveal the diversification trap that most investors fall into and why the safest choice might actually be the riskiest. Let me introduce our 3 heavyweight contenders. First up is QQQ. Think of it as the turbocharged sports car of ETFs. It tracks the NASDAQ 100, which means you're betting big on the top 100 non-financial companies. We're talking Apple, Microsoft, Google, Tesla, the companies that either make you rich or break your heart. Then there's SPY, the stable freighter of the investing world. It follows the S&P 500, giving you the 500 largest U.S. companies with a proven track record going back decades. Finally, VTI is like the ultimate road trip van. It literally owns a piece of almost every publicly traded company in America, from giants to tiny startups, giving you the entire U.S. stock market in one fund. Now here's where things get interesting, and honestly, a bit shocking. QQQ has absolutely dominated over the past year, with a stunning 22.91% return. SPY delivered a solid 19.18%, while VTI came in at 17.18%. But here's the kicker. If you invested $10,000 in QQQ 10 years ago, you'd have over $67,000 today. That same amount in SPY would be worth about $54,000, and VTI would have grown to around $52,000. That's a difference of over $15,000 just from choosing QQQ over the safer options. But before you rush to put everything in QQQ, let me tell you what happened during the dot-com crash. While the S&P 500 fell about 49% from peak to trough, the NASDAQ 100, QQQ's index, plummeted a devastating 78%. We're talking about losing nearly 4/5 of your money if you bought at the wrong time. Even recently, during 2022's tech sell-off, QQQ dropped 32.58%, while SPY fell 18.18%, and VTI declined 19.52%. That's the price you pay for QQQ's incredible upside. When tech stumbles, you stumble hard. Here's something most investors completely ignore until it's too late. Fees. They seem tiny, but they're like a slow leak in your tire that eventually leaves you stranded. VTI charges just 0.03% annually. That's only $3 for every $10,000 invested. SPY costs 0.09%, or $9 per $10,000. QQQ hits you with 0.20%, costing $20 per $10,000. Now you might think, what's the big deal? It's just a few dollars. But over 20 years on a $100,000 investment, that difference between VTI and QQQ cost you over $7,000 in fees alone. And here's the beautiful irony. Despite QQQ's higher fees, its superior performance has more than made up for those costs historically. But remember, past performance doesn't guarantee future results, and that fee difference becomes a bigger drag if QQQ's outperformance streak ends. Now let's talk about the elephant in the room, concentration risk. QQQ put 60.84% of your money into technology stocks. Imagine if 60% of your entire financial future depended on whether people keep buying iPhones and using Google. QQQ's top 10 holdings make up over 51% of the entire fund. That's like putting half your eggs in just 10 baskets, even if they're really nice baskets. SPY spreads things out more evenly. Technology is still the biggest slice at 33.60%, but you also get financials, healthcare, and 9 other sectors. It's like having a balanced meal instead of just dessert. VTI takes diversification to the extreme with 3,561 different companies. Its top 10 holdings only represent 31% of the fund, and you own everything from Apple down to tiny companies most people have never heard of. The question is, does more diversification always mean less risk, or does it also mean less reward? Let me paint you 3 scenarios that every investor needs to understand. First, imagine it's March 2020. COVID hits, markets are crashing, and everyone's panicking. During this crisis, QQQ actually recovered faster than the others, gaining 54.86% in 2023 compared to SPY's 26.18% and VTI's 26.05%. The concentrated bet on technology paid off massively as the world went digital overnight. Now picture scenario 2. It's 2000, and everyone thinks the internet will change everything. Sound familiar? The Nasdaq was flying high until reality hit. QQQ investors watched their funds lose 78% of their value over the next 2 years, while SPY investors only lost 49%. The diversification in SPY literally saved people's retirement accounts. Here's scenario 3. The Federal Reserve starts aggressively raising interest rates like they did in 2022. Growth stocks, especially high multiple tech companies, get hammered because their future profits become worth less in today's dollars. QQQ suffered more than the others because it's packed with these growth darlings. If you owned SPY, you had some protection from financial stocks that actually benefit when rates rise. There are some behind-the-scenes differences that most people never consider but can impact your returns. SPY operates as a unit investment trust, which is just a fancy way of saying it's structured slightly differently for tax purposes. QQQ and VTI are structured as open-ended investment companies, which generally provides more flexibility. All 3 use something called the creation and redemption process through authorized participants. Basically, this keeps the ETF price in line with its underlying stocks and provides liquidity even when markets get crazy. Here's something cool that actually makes you money. All 3 funds lend out their stocks to short sellers and keep most of the profits. It's like renting out your car when you're not using it. This securities lending income helps reduce the tracking error and can slightly boost your returns. Think of SPY as the reliable sedan that always gets you where you need to go. QQQ as the high-performance sports car that's thrilling but demands more attention. And VTI as the versatile SUV that can handle any terrain. Here's what the professionals won't tell you in their marketing materials. Current market conditions in 2025 show some concerning signs for QQQ. The Nasdaq 100 is trading at over 30 times earnings compared to the S&P 500's 24 times earnings. When stocks get this expensive, future returns typically disappoint. As one fund manager told me, sometimes diversification is the only free lunch in investing, and right now, that lunch looks pretty appetizing. The math is simple but brutal. If you're chasing last year's winner, you're often setting yourself up for next year's disappointment. Mean reversion is a powerful force in markets, and QQQ's incredible run might be setting up SPY and VTI for their turn in the spotlight. But here's the thing, nobody knows when that rotation will happen, and it could take years. Let me break this down crystal clear. Choose QQQ if you're young, have a high risk tolerance, and believe technology will continue dominating the economy for the next decade. You're essentially making a concentrated bet on innovation, and historically, that bet has paid off handsomely. Pick SPY if you want the middle ground. Solid large cap exposure without the extreme concentration risk, reasonable fees, and a track record that goes back generations. Go with VTI if you want to own the entire US economy at rock bottom costs, maximum diversification, and you're not trying to beat the market. You just want to match it. But here's the plot twist. You don't have to choose just one. Many smart investors use a combination like 60% VTI for broad exposure, 25% SPY for large cap stability, and 15% QQQ for growth enhancement. So here's my challenge for you. Which ETF matches your personality and goals? Are you the aggressive growth seeker who wants QQQ's rocket ship ride? The balanced investor who likes SPY's steady reliability? Or the diversification devotee who wants VTI's everything everywhere approach? Drop your choice in the comments and tell me why you picked it. I read every single comment and love seeing your reasoning. And here's something fun. Let's crowdsource the ultimate portfolio. If you had to put percentages on all three, what would your ideal mix be? Maybe you're thinking 80% VTI, 20% QQQ, or perhaps 50% SPY, 30% VTI, 20% QQQ. Share your ideal allocation below, and I'll compile the results for a follow-up video. If this breakdown helped clarify the choice for you, smash that like button. It genuinely helps the algorithm show this to other investors who need to see it. And if you want me to dive deeper into any specific ETF or compare other investments, let me know in the comments. Subscribe for more no-nonsense investment analysis. And remember, the best investment strategy is the one you can stick with through both good times and bad. Until next time, invest wisely and stay curious. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.